Hello and welcome to Money, Me and COVID-19, where we meet with leaders from the world of finance, business and investing to find out what's really going on out there and how we as investors can prepare ourselves to come out the other end of COVID-19 in as good a state as possible. My guest today has spent the last 15 years as editor of Britain's best-selling financial magazine, Money Week, which incredibly is coming up to its 1000th issue very soon. And last year he published his first book, The Skeptical Investor. His name, of course, is John Stepek. John, welcome to the program.
Hi, Graham. Good to see you again.
Now, I can't believe it. You know, it's always, I imagine, difficult to get a weekly magazine out at the best of times. But on behalf of Britain's investors, let me publicly thank you for continuing to get it out the door every week, even during lockdown. I imagine it's been a little bit of a challenge.
No, thanks very much for that, Graham. Strangely enough, actually, it's not been anywhere near as difficult as we expected. I mean, I think that this is actually one of the fascinating things, and we'll probably talk about this a bit later, but our team have been working together for a long time. And so we kind of know, everyone knows what they're doing, everyone understands and kind of rolls well with each other. And we found that doing that remotely hasn't actually been anywhere near as difficult as we'd worried. It is the first time that we've put together issues entirely remotely, but we have always had people working from home. Obviously, we work with a lot of freelancers. So actually, it's been, fingers crossed, I don't want to jinx it, but so far it's been easier than I expected. And I think that's us coming up to six or seven issues now that we've done entirely remotely. So yeah, thankfully it's not been too bad.
Okay, well, I mean, for a man who's had weekly deadlines for 15 years, you're not looking too bad on it. But anything special planned for the anything special planned for the 1000th edition?
Yeah, we'll give a big retrospective where we talk about what's happened over the last 20 years. It's also our 20th anniversary this year, so that's happening in November. So we're actually going to go a bit bigger on that. But in the 1000th issue, we're going to take a look back at some of our favourite covers, look back at some of our biggest calls, both the successful ones and the less successful ones. And also, we've ran a little kind of competition to ask the readers to tell us where they would invest £1,000 right now if they could only, if they had to lock it up for 10 years. So we've already had actually quite a lot of entries to that. So they make for interesting reading. The readers are a smart bunch. It's and it's more than just things like gold, which is the kind of thing I would obviously expect from Money Week readers, but we also an awful lot of other interesting ones. So I'm looking forward to pulling that page together and putting it in the mag next week.
Okay, great. Well, I mean, obviously you've chosen a very challenging time to have your 1000th issue. So all pleasantries aside, you've had a bit of time now to reflect on the impact of the virus and also, of course, on government's response to that. So, what's your big picture take on the impact of these measures on the economy and how we go forward from here?
Well, I mean, my big picture view for a long time has been that inflation has got to be the ultimate kind of end game for all of this. And that's been my view pretty much since the kind of 2008 financial crisis. And I'll unpack that a bit, but I suppose my view now, there are still a lot of deflationists out there, and obviously the market is largely positioned for deflation in some ways, certainly the bond market. My view is that central banks have demonstrated very clearly that they will not let the banking system collapse, and they will take any steps necessary to prevent that from happening. And we've already seen, I think, during the COVID-19 crisis, just how serious they are about that. I mean, they've already done much more than they ever did in 2008. You've got the Fed buying junk bonds effectively. Also doing big swap lines with other central banks in emerging markets to try and prevent any big emerging market crisis. So all of these kind of potentially deflationary systemic blow-ups are being plugged by central banks as soon as they arrive. The only risk from that perspective I still see is the European Central Bank, which is a slightly separate issue, but obviously they've got the political problems that stop them from being able to act as effectively or dramatically as the Fed or the Bank of England. So, long story short, if you cut off the deflationary kind of collapse scenario, which is basically driven by the financial system collapsing, then what you're left with is eventually I don't see how there can't be inflation, because you get governments spending so much money to get us through this particular crisis, and then we're going to be left with that, and they're going to have to find some way of repaying that. And believe me, the population is not in the mood for tax rises and spending cuts.
So I mean, I think logically, I kind of intellectually agree with you. But then I look at, what's happened since 2008, and particularly I look at what's happened in one of MoneyWeek's favorite investment countries, which is Japan. And I think, well, they've been doing this for decades and they've not managed to generate any significant inflation. So is there any limit to how much money and QE printing and QE we can do without causing inflation?
No, I think that's a really fair point. Japan's unusual, and also if you kind of read James Ferguson's stuff, James Ferguson's a regular contributor to MoneyWeek, and he also writes a research for Macro Strategy Partnership. And James often points out that basically what happened in Japan was not the kind of QE that the West has been doing since 2008, but also that we're going to be doing. I think the major difference now is that, governments are going to have to spend so much. And the fact that you've just been talking about, is there no limit to the QE that we can do? That's coming from someone who, is clearly slightly concerned about money printing, and somebody who has worries about it. And yet you're now at the point where you're thinking, well, actually, is there a limit to this? Which is reasonable after 10 years. But if you're thinking that, so is everyone else. And, all these people talking about modern monetary theory, or MMT, which is basically arguing what you've just said. You can print as much money as you want, as long as inflation isn't a problem. And the problem is, eventually inflation will become a problem if you keep printing as much money as you want. And what we've got now is a situation where governments are going to come out of this with kind of wartime levels of national debt. And what actually happened after the war was basically money printing in order to get that debt down. But that did also eventually lead to inflation. So I think that's where we are. And I also think that we don't have the patience anymore. I think that what you're going to find is that quite rapidly after this, not only is the economy going to bounce back, because at the end of the day, you can shut it down, but there is going to be, I would think there will be a bigger bounce back. This isn't the depression that we're going into. I don't necessarily think we've got a V shape. I do think we will get a rebound. And so when you get that, plus all of the money printing that's going on, put it this way, if that doesn't get inflation going, then yeah, I'm going to have to put my hands up and say, I don't know what will.
But I suppose one of the challenges with this is to try and put a timeline on it. And when I raise this sort of question with Tim Price, he starts quoting how long the Soviet Union lasted from 1917 to 89, whatever. So and even if you look after World War II, it wasn't really till we got into the 70s and the oil crisis and stuff that we saw real significant inflation. So how far away do you see this inevitable inflation being from where we are today?
Yeah, that is a good question. And I'm not going to lie, I have thought that it would come earlier than it has. I suppose that my view on it is that with every crisis that we have, we're taking ever more dramatic measures. Whenever we're coming out of this, there's going to be a lot of unemployment to deal with. There's going to be, entire industries that have been, essentially the legs cut out from underneath them. And there's also going to be, as I said, kind of no appetite for either tax rises to pay for this, or for public spending cuts. I mean, particularly not public spending cuts. And I know that Treasury has kind of talked about it, but I think that everyone's kind of missing the point. That's what guys in the Treasury are paid to do. they have to sit down and kind of think, oh yeah, how are we going to pay for this? And the fact is, how are we going to pay for it? We're going to pay for it because the Bank of England is going to print the money to buy the bonds that the government needs to issue to pay for this. That's it. It's not going to be any more complicated than that. They'll kind of fig leaf it in some way, but that's what's going to happen. I also don't think that we're not going to see the same level of damage to the underlying kind of economy as we did, obviously, during the war. We're going to be coming out of this, and as I say, we people having kind of greater expectations of what the government, etc., can do for them. In the US, you've also got Trump coming up for election, so he's not going to be keen to kind of turn the spending taps off. So to be honest, I would expect inflation to get up to levels where we start to feel a little bit nervous, probably within a few years of this. I really don't think that it's this is 1945, and we're waiting for 1970. I think it's much, much closer than that. And certainly if you look at the way that, for example, gold is reacting right now, then that's suggesting that people at the very least kind of think that inflation might be at risk, or certainly a collapse in real interest rates, which is ever so slightly different, but it's still a good reason to hold gold.
Yeah, and on a recent Money Week podcast, Russell Napier said, who has been, let's face it, an arch deflationist, said, I'm never going to have to write about deflation again. We're in for 20 or 30 years of inflation. I mean, do you buy into that opinion?
I think Russell's one of the smartest guys in markets, and he's certainly done a lot more work on this than almost anyone I know. And it's also worth bearing in mind that deflationist view has been correct for a very long time. So when you've got people like Russell and also people like Albert Edwards at Societe Generale saying that actually this is pretty much the end of the line, we can see from the behaviour changes in the political sphere that this argument for ongoing deflation is pretty much at an end. Then that says something to me, because for all people kind of take the mickey out of Albert for being an uber bear all the time, and that's completely reasonable in that he's been wrong on the S&P 500, for example. But at the same time, if you'd kept the majority of your money in bonds, and I can't say that I've been a fan of bonds, you've done incredibly well over the last 10 years. So I think that while it's easy to kind of parody his position slightly, he's got a lot of things right. And the fact that he now thinks that we're coming to the end of that thesis, potentially without yields ever turning negative, although he's got mixed views on that. I think that does say something, and they're kind of worth listening to.
Okay, I mean, I think one of the hard challenges now for investors is to kind of see through all the fog and the noise and the politics and everyone's trying to hide behind science while making highly political decisions at the moment. What sort of guidance could you give to befuddled investors trying to work out what best they can do to survive and thrive in this COVID-19 economy?
Well, I mean, I think the first thing you look at is, you should already have a plan. If you are investing for the long term, then you should have some sort of logical way that you're going to get there. So take your plan, look at it and think, has any of this changed? What I want, what my return expectations are, and what my asset allocation should be. And if I'm being honest about it, I'm not sure that COVID-19 changes that much. I think that it's accelerating trends that were already in place. There are definitely some things that I think are going to change more than others. And I'm absolutely not trying to be a knee-jerk contrarian here and saying, nothing's going to change. I don't think that's true. I think some things will shift. But as far as your own portfolio goes, If you've got 30 years to retirement, say, then there's no need to worry about the collapse in stock markets in March, because you do have a long time to recover from that. The areas I would look at is, I know I'm a stuck record on this, but if you don't have any exposure to gold, then I would look at that. I would kind of think about, well, there are good reasons to have it in your portfolio as a form of insurance, if nothing else. I would probably be looking at your exposure to assets that benefit mostly from a deflationary environment, and then perhaps considering what might happen to them if we do get into a more inflationary environment, and just think about what's the balance in your portfolio like from that point of view. Should you be perhaps hedging against inflation a bit better than you are today? But other than that, I wouldn't be worrying about making too many big changes.
So when you say assets that thrive in deflation and assets that thrive in inflation, can you just give us some examples of each of those?
Yeah, I mean, anything that's fixed income does well in deflation. So government bonds are a good example. All that means is that, so if people are worried about deflation or interest rates are low, then people will pay highly for a regular fixed income. And so that means that government bonds, for example, have done very well during the last actually it's about a 40 odd year bull market now. However, if inflation takes off, suddenly that fixed payment becomes worth a lot less, and it becomes a lot less attractive. So you could get a kind of sell-off in fixed income assets if suddenly people start thinking, oh wait, inflation's the thing I need to worry about. As for assets that do well in inflation, that's usually kind of real assets, so physical assets. So commodities, which have actually underperformed drastically compared to stocks and pretty much every other asset class in the last 10 years, would do well from a more inflationary environment. Gold tends to do well in an inflationary environment. Gold's price is more related to interest rates after inflation, so real interest rates. But loosely speaking, it usually does okay in an inflationary period. Stocks can do fine until inflation hits a certain level. Once inflation starts getting above 5-6%, it starts to be, stocks don't outperform anymore. You ideally probably want stocks that have got pricing power, so people who provide consumer staples, that kind of thing. And obviously there's index-linked bonds as well, do fine in inflation. The trickier one is property. So property is, on the one hand, it's a real physical asset. It should keep pace with inflation. The tricky thing is you buy it with debt, and obviously once inflation gets to a point, interest rates also start to rise. So the risk is that your leverage kind of does for you if you're buying property. So that's why that's a slightly more nuanced argument. But yeah, that's basically it.
Okay. I think I'm aware of the expression that the markets can stay irrational longer than you can stay solvent. And recently, we've seen this. We saw a 30% drop, and then the market's been on a tear recently. And I'm thinking to myself, why is there such a disconnect with the biggest economic catastrophe for decades going on, and yet the markets are going up? So, and a lot of people are piling in now, opening new brokerage accounts and so on. I mean, is this what you might call a suckers rally, or do you think the worst is truly over and that the markets are just discounting any further impact from COVID-19?
Oh man, yeah, that's the $1 billion question, isn't it? Approaching it from a sentiment point of view, because I must admit, one thing I always like to do, and that's what the skeptical investor is about, is looking at the mood and trying to get an idea of how people are feeling. And if I'm honest, I think that it's quite possible that March the 23rd was the low. I felt that getting up to there, we were approaching a sense of hysteria and concern that we hadn't seen for a very long time. And it did remind me of kind of 2009 and the kind of mood around the bottom there. The other thing to remember is that markets aren't the economy. I mean, most kind of normal people, if you like, or people that don't kind of talk about finance a lot, kind of feel as if there should be a connection between GDP and markets. And in the very, very, very long run, there kind of is. But on a week-to-week, month-to-month, year-to-year basis, there isn't really much correlation. And basically, that's just because markets are obviously discounting mechanisms. So they kind of look to the future, if you like. The thing that I think would change that view is if we have to have more lockdowns. If we end up, people go back, the infection rate spikes up, and it turns out that really we're just going to go back to effectively, the last month, but have to do it in November again. That, I think, would be the sort of thing we would need to see another bottom. And obviously, I mean, that could happen. So far, it basically doesn't look like that's happening. And I'm not sure how big an appetite people will have for further lockdowns after this one, even if there is a spike. I think that would be the big thing. But bar that, I think there's a very good chance we've seen the bottom, which doesn't mean that markets are good value now. That's the only thing.
Okay, but I mean, I think it's interesting in a sense. The QE genie came out of the bottle of, say, 2008, and has certainly never been put back in it. One of my hobby horses and concerns is that the kind of martial law house arrest genie has come out of the bottle this time around, and I fear that's not going to go back in the bottle either, and it'll be used much more in the future by governments, because frankly there's been so little kind of whimper of protest about the way people have given up their freedom. I mean, do you see that as at all a negative thing that's come out of the government response to the COVID-19?
Yeah, I mean, I think you're right to be worried about that. There's a very good kind of video of Steve Baker, MP, who I think is like one of the only Libertarian MPs in the House of Commons, kind of, regretfully saying that, okay, I agree we need to do this just now, but we need to get this stuff off the statute books as soon as we possibly can, because some of this stuff is incredibly draconian. And I do worry about it. I think that it's yet another advance towards this idea that the government and central banks can sort everything out, and that they should be our first port of call for every possible, disaster scenario. Now, I'm not necessarily disagreeing with the lockdown. I think, the honest truth is that I try not to have a huge opinion on this, because I'm not a scientist, and everyone that I see every day on Twitter and in the media spouting their mouths off about whether we should be shutting down or reopening or whatever, it's just noise, and I'm not going to help anyone by contributing my uneducated view on that. But you're right, it is a worry that we have so kind of readily succumb to this, which is fine. But you wonder what it would be if there was a different party in power, say, just now, and you also wonder what will happen the next time a big crisis happens, because we've crossed this Rubicon now, and there's demand, there's appetite out there. I think it's interesting that the devolved parliaments are kind of have chosen now to differentiate themselves from the English Parliament by being more draconian than the English Parliament. So England's now opened up the housing market, and I wrote about it the other day and stupidly forgot to point out that it was England rather than whole of the UK. And obviously I got a few emails about that, which is fair enough, because when I was growing up in Glasgow, I used to think, God, the media is awfully, Anglo-centric. So I used to bug me too. So I don't have a problem with that. But I think it's interesting. It's interesting that those, they're now kind of taking responsibility at the point where they can differentiate themselves by being tougher. And yeah, it's just a worry. You're right.
Okay, well, I mean, let me confess a guilty secret. Whenever I tear the shrink wrap off my copy of Money Week, the first place I go is the inside back cover to read Bill Bonner, who, for me, he's the financial equivalent of playing Leonard Cohen records in your student bedsit, because no matter how miserable you're feeling, there's obviously somebody else who's worse. Now, he's painting this picture of this whole thing being the end of the American empire and all the rest of it. You know, do you feel as strongly about it as that, or do you think he's perhaps slightly more bitter, twisted, and cynical than you are?
It's like, I love that. I need to tell him you're the Leonard Cohen of financial journalism. That's great. I mean, I don't feel as negatively as Bill, but I mean, I'm not sure anyone in the world does. But I think that, I mean, on a grand scale, and Bill's a grand scale kind of thinker, all of the things that he talks about are correct in terms of trajectory. You know, the end of Pax Americana, if you like, where America's been the global police officer, has started to happen under Barack Obama. So that kind of thing, and the idea of, and obviously all empires have kind of crumbled in the past, or at least handed over to someone else. And Bill isn't the only one talking about that by any means. I mean, now it's kind of mainstream for people to talk about, I don't know how you pronounce his name because I'm not a classicist, but the Thucydides trap, where basically China and the US, I mean, the implication is that the US and China will have to go to war at some point. So a lot of people are talking about this. And empires do tend to end with currencies being debased, you know, the sense that they're past their best, that, you know, the people are restive, the politicians or leaders are getting ever more populist. And, you know, I mean, Donald Trump is not somebody who ideally I'd really want to be president. You know, I realise that might be a controversial view one way or the other with some people, but regardless of whether you find his opposition irritating or not, I don't think anyone can turn around and say that, oh, he's ideal for the job. So I think that I can see why Bill's concerned, put it that way. At the same time, there is an awful lot of ruin, you know, in a nation. I think, as Adam Smith put it. So that, I mean, what it boils down to is you can't put a timeline on this stuff that I feel is investable. And at the moment, the US dollar is still the global reserve currency. It's going to take an awful lot to shift it from that position. So I suppose as an investor, actually making a bet on the US empire ending is much trickier than understanding that one day it will end.
That's a great point, but also it segues very neatly into the next topic I want to talk about, which is currencies, and particularly we've got the move towards perhaps cryptocurrencies, but now perhaps even more interesting, or should I say sinister, this move towards state-controlled digital currencies, where, you know, some people are saying, well, that's just a logical technological progression. Others are saying it's the kind of final nail in the coffin of a free society. And hey, surprise, surprise, China is leading the way in this. What's your take on, first of all, sort of the future for cryptos and bitcoins, and then let's segue into digital currency?
Yeah, I mean, I find this stuff fascinating. And while I don't write about it much, I do think that, I mean, there's obviously political pressure to have digital currencies. And the tricky thing is that the last thing governments want or can allow is for someone like Facebook, for example, or something like Bitcoin to become the dominant kind of global currency, if you like. And to be honest, I don't think that's possible. The reason I don't think it's possible is because of political objections to it. That's what it fundamentally boils down to. So I think that Bitcoin, for example, will probably continue to be an asset. It will probably continue to exist. I don't think it will ever be the go-to asset for exchange. I can see it being a sort of form of digital gold, though. And obviously it already has kind of real uses in terms of how do you get money from a place like Venezuela to somewhere else without, having to, stick things, kind of, hide them away in your coat and that sort of thing when you're going through customs. So I think that the Bitcoin's demonstrated that it has a use, but I don't think it's ever going to be the main kind of form of exchange. And the thing is, as far as governments go, I mean, one of the ways of getting out of the massive debt hole that we're going to be in, and that we were already in, to be honest, is a thing called financial repression. Now, Russell Napier talks about this all the time, and he's not the only one. Really what this is where governments artificially hold down interest rates so that essentially savers' savings are inflated away, and debtors' debts are inflated away. So it's a transfer from people with money to people with debt. That's what it boils down to. And one of the ways that you could enforce this much more efficiently and much more rapidly is to replace cash with, a kind of central bank issued digital currency. And just the other day, Ken Rogoff, a big name economist, was making the argument yet again for negative interest rates. And if you want to impose a negative interest rate, you have to have a fully digital currency, basically. Because there's a point at which if you impose negative interest rates, at 1% people won't bother taking the money out of the bank, but at 5% they will. They will take their cash out of the bank and they'll stick it under a mattress if they have to. If there is no cash, you can't do that. And effectively, the central bank then just has essentially taxing authority. It can say, because that's a wealth tax. If you're having to pay 5% a year simply to have your money somewhere that you can access it, and inflation is sitting at 5% or even 2%, then you're getting money stolen from you at a rate of, kind of 7% odds a year. So, I mean, I can entirely see how that is, and it'll get sold to us as convenience.
Yes, and financially literate people everywhere will think, oh, that's a good idea.
Sadly, yes. And even, the financially literate ones will make the argument, oh, well, why not? It's that's a worry. And that then, I mean, to be honest, you can see how down that road, that's where the collapse comes, because at some point, people also will not tolerate that. And I think this is interesting because we're getting to the point where politics and money, and if you like, the kind of backdrop to all of these rules that we've built and are now steadily demolishing kind of becomes clear. Because on the one hand, people who say that you can print money until inflation arrives are correct. There isn't a mechanism to prevent that, and there isn't necessarily a direct kind of obvious relationship. It's not like gravity. But the point is, these rules kind of exist because it's almost like a social contract. Money is a social contract. The rules by which we operate money are a social contract. When you start breaking that, then what I think a lot of these people don't realize is you're not just changing the rules by which money operates, you're destroying the social contract from within. And to be honest, I think that's one big reason why we've had the level of political, not unrest, because I wouldn't go as far as to call it unrest, but the political shifts and the anger that we saw after 2008 is as much to do with people feeling that the rug was pulled out from under them, and the way that the financial system, the way they thought it worked, wasn't the way that it worked. And I think that that's only going to get worse as we start venturing into ever more esoteric ways of kind of doing strange things with money that most people in the street simply can't wrap their heads around.
And that's critical, because to me, in my fantasy world, every man, woman and child in this country would be forced to read Money Week. But I suspect
good idea.
Your subscriber base, I fear, is slightly less than 60 million. Now, in this time of crisis, interestingly, churches, for example, have found that since they've been forced to go online, they've had much bigger attendance to their online services. Is there some way in which we can spread financial education more effectively so that people will push back against these very esoteric measures you've been describing?
I mean, that's an interesting idea. I mean, the truth is, I don't know. I mean, one good thing about crises, if you like, is that they do increase people's appetite for this sort of information. You know, I don't think I'm giving away any commercial secrets by saying that in the 2008 financial crisis, you know, our website traffic, our circulation went up strongly, and we're seeing something similar happen just now. People have a real, I think people are intelligent by and large. The main reason most of them aren't necessarily interested in finance is because A, it's slightly technical, B, it's a little bit boring. But, you know, I'm not interested in plumbing for the same reason. You know, it's like, if I had to, I could wrap my head around it. And I think that's the problem. People wrap their heads around it when they have to. And I mean, to be fair, the backdrop is such that people are being forced to understand more about it. You know, like we all have to, you know, unless you have a defined benefit pension now, and they are rare outside the public sector, then you do have to take some interest in your own pension because you're the one that's going to have to manage it when, you know, you come to retire. The one problem with that is that obviously most people don't start worrying about it until they're in their mid-40s or actually that's quite early thinking about it. Lots of them it's not till they're in their mid-50s. So I think we need to it would be good to find a way to get people interested in this stuff early on. But I must admit, you know, there's so much out there. I mean, there is so much stuff on the internet. I am constantly gobsmacked by the level of incredible financial education you can get for free. And I'm not just talking about my own newsletter or Money Week. I mean, Robert Shiller, he's a Nobel Prize winning economist. He has an entire Yale course on capital markets aimed at first-year students online. You can watch the whole thing for absolutely nothing. You'll get an excellent grounding in what markets are about. And Shiller's you couldn't describe him as a right-wing kind of guy. You know, he's not looking to indoctrinate you, he's just explaining it. There's loads of other particularly the Americans are particularly good at this, who will just, you know, talk well about valuation, you know, about markets, about economics. There's so much stuff out there. So there is an element of, I don't know how, because, you know, the water is everywhere, you know, and you can't make the horses drink it.
Okay. Well, we've covered a lot of subjects, very wide-ranging discussion, John. To bring things to a conclusion, let's just imagine I'm holding a gun to your head. I've kidnapped your children, and the ransom demand is the one piece of investment advice you would offer for the 2020s. What would the answer be?
Oh man, I'm so boring. I hate to say it, I'm going to have to say own some gold on this one. And I suppose actually, if I was wanted to make it a tiny bit fruitier, I would probably say at the moment, actually, gold miners are probably a decent bet. They have been appalling investments. Just to be very clear, terrible investments for possibly right up until about 2016. But the reason I would say that this time is different is because A, they've got a lot more capital discipline now, which means that unlike during the previous gold boom of the early noughties, they'll be able to benefit from a rising gold price and their kind of operational leverage to that in a way that they didn't in the previous boom. So yeah, so my sort of buy gold for the kind of more conservative side of things, and yeah, if you want to get punchier, then gold mining stocks look interesting.
Okay, brilliant. And I guess prepare for inflation coming somewhere down the track. So John Stepek, thanks very much for joining us today.
Thanks, Graham.